The U.S. stock market is currently in pre-market trading on Friday, October 24, 2025. As of the last market close on October 23, 2025, Applied Digital Corp, ticker APLD, closed at $33.38. This was a significant, powerful move, with the stock gaining $2.76 or 9.01% in a single session. Now, when you see a 9% surge on a name like Applied Digital, especially one with its history, the immediate assumption for many is that the old crypto volatility is back. The expectation is that this is just a high-beta, speculative name, formerly Applied Blockchain, catching a bid, maybe something day traders on the Robinhood app are piling into. But that is not what is happening here. The reality is that yesterday's 9% pop is one of the most significant, validating events in this company's entire history. It is the market being forcibly confronted with a new reality, one that is completely disconnected from its old crypto mining identity. That surge was a direct response to Applied Digital announcing it has signed an approximately $5 billion 15-year lease agreement with a major unnamed US-based investment-grade hyperscaler. This isn't a speculative bet, it's a massive, long-term contract for its artificial intelligence infrastructure. The common ground, the expectation that has defined APLD for years, is that it's a proxy for Bitcoin. It was seen as a company in the tough, low-margin business of building data centers for cryptocurrency miners. This is a cyclical, brutal industry. That's why so many traders saw it as a short-term vehicle for Robinhood stock trading, not a core holding for a serious investment portfolio. The assumption was, and for many still is, that this is a low-quality business. But the reality, which this $5 billion deal slams onto the table, is that Applied Digital has successfully pivoted. They are no longer just a crypto landlord. They are now a specialized builder of AI factories, high-performance computing (HPC) data centers designed specifically for the massive power and liquid cooling needs of AI models. The crypto business is now their legacy segment. The AI infrastructure business is the entire future, and that future just got underwritten to the tune of $5 billion. Let's really break down this recent action because it's critical. That 9.01% jump was on heavy volume, and it was a direct reaction to the press release about the new 200-megawatt AI factory lease at its Polaris Forge 2 campus in North Dakota. This single deal represents approximately $5 billion in total contracted revenue over the 15-year term. This new agreement brings the company's total leased capacity in North Dakota with two of the world's largest hyperscalers to 600 megawatts. This is the kind of long-term, predictable, contracted revenue that institutional investors, the kind who manage Fidelity accounts or build Schwab intelligent portfolios, dream of. It's the polar opposite of the volatile, unpredictable revenue from crypto mining. This news immediately forced analysts to re-rate the stock. We saw Craig Hallam and H.C. Weinberg reiterate their positive stances, with price targets climbing into the 40s. But here is the other, more explosive side of this move, the short interest. According to the most recent data from Fintel, APLD has a staggering 72 million shares held short. That represents over 30% of the company's entire float. This is an enormous, crowded, and now very painful bet against the company. These short sellers were all betting on the expectation that APLD was a failing crypto company. They were betting on the cash burn, the high debt, and the execution risk. Yesterday's $5 billion contract is a direct, catastrophic threat to that short thesis. That 9% move was not just new buyers coming in. It was almost certainly the beginning of a massive short squeeze. Shorts were being forced to buy back shares at a loss to close their positions, which only adds fuel to the upward price pressure. This is a classic expectation versus reality battle playing out in real time, and the shorts are trapped on the side of an outdated expectation. This news also helps reframe the company's recent earnings report from early October. For its fiscal first quarter 2026, the numbers looked confusing on the surface, which fed the bear narrative. Revenue was a strong beat, coming in at $64.2 million, up 84% year over year and well ahead of the $51 million forecast. That was the reality of strong demand. However, the company reported a net loss of $27.8 million or 0.11 cents per share. The shorts and skeptics pointed to this loss. But why was there a loss? The company's costs skyrocketed. Cost of revenues was up 144% and SG&A was up 165%. A huge chunk of this was from tenant fit-out services and stock-based compensation. In plain English, they are spending a massive amount of cash right now to build and customize these new AI data centers for their clients, like CoreWeave and this new hyperscaler. It's growth-related spending, not a sign of a failing core business. The $5 billion contract is the proof that this spending is not in vain. It's securing future revenue. So, let's be perfectly clear about what Applied Digital does now. It has effectively split into two companies. First, there's the legacy data center hosting business, which operates facilities in Jamestown and Ellendale, North Dakota, primarily for crypto miners. This segment is operating at capacity and provides steady, albeit less exciting, cash flow. Second, there is the high-growth HPC hosting business. This is the AI Factory division. These are brand new campuses like Polaris Forge 1 and Polaris Forge 2, built from the ground up for power density and liquid cooling needs of AI chips from Nvidia stock. As the CEO correctly stated, the bottleneck in AI is no longer the GPUs. It's the lack of specialized data centers to plug them into. Applied Digital is positioning itself as a key builder of these specialized facilities. This makes APLD a very specific kind of investment. It is not a stock for a passive SoFi robo-advisor or a diversified Fidelity mutual fund. In fact, most Fidelity ETFs that hold tech would likely skip APLD due to its volatility and small cap status. This is a stock for self-investing. It's a high-risk, high-potential reward play that you would find and trade on a Fidelity trading platform or through interactive brokers. It's the kind of name that explodes in popularity on investing sites and SoFi Invest forums because the story is so compelling and the disconnect so large. People on the SoFi trading platform and Robinhood are deep into SoFi active investing on this name. This is not a set-it-and-forget-it holding for your Fidelity IRAs. This is an active bet that the company can execute its transition. This is why online investing platforms are so focused on it. It's pure narrative friction. This company is not Tesla stock or Apple stock, which are mature giants. This is a small, scrappy builder trying to scale at a breakneck pace. This is where the investment help and real analysis come in. The risks are as massive as the opportunity. Looking forward, the primary catalyst is simple: more deals. This new hyperscaler client has a first right of refusal on the additional 800 megawatts of capacity at the Polaris Forge 2 campus. That represents billions more in contracted revenue. The second catalyst is the ongoing short squeeze. With over 30% of the float short, any continued good news could send this stock flying as more shorts are forced to cover. The third catalyst is simply execution. Every time they complete a data center building on time and on budget, they de-risk the story and prove the bears wrong. However, the risks are not trivial. The number one risk is execution. Announcing a $5 billion deal is easy. Building the highly complex 200-megawatt liquid-cooled facility on time and on budget is incredibly difficult. Any delays or cost overruns could be disastrous. The second major risk is capital. This build-out is astonishingly expensive. As of the last report, APLD had about $687 million in debt and only $114 million in cash. They are financing this growth through complex partnerships like one with Macquarie and by issuing preferred stock. This is a race. They must build the facilities and start collecting revenue before their capital runs out or the debt payments become overwhelming. This is a balance sheet risk that you would analyze deeply in your individual brokerage account, perhaps on the Fidelity mobile app or using the tools at Interactive Brokers. This is not a stock for those just starting to invest online. The third risk is competition. Applied Digital is not the only company to notice this opportunity. Riot Platforms, another former crypto miner, is also pivoting to HPC. And then there are the established data center giants like Equinix. APLD is betting that its specialized designs and speed to market give it an edge. Finally, there's customer concentration. With 600 megawatts leased, the vast majority of their future revenue is tied to just